Betting on the gold price can be a dangerous business, but there are ways to potentially make big gains from an increasing gold price over time. One of the first places investors will turn is the gold sector of the stock market. Gold stocks are claims on gold royalties, gold streams, or gold mines. The value of carefully selected stocks could rise at a faster rate than gold itself. One of the best ways to speculate on a rising gold price is via junior gold miners. Junior mining companies carry far greater risks than senior miners, which is why you need to invest in them very carefully. For one thing, junior miners haven't built up the cash reserves they need to weather a crisis or even a downturn in gold prices. In fact, most junior miners don't have working mines. Instead, they are actively looking for gold or trying to build mines. In other words, they rarely have revenues. These juniors survive by attracting new investors or partnering up with companies with deep pockets. If these sources dry up, a junior will have to prove it's onto something big before it runs out of money. The spectre of bankruptcy hangs over many of these tiny companies. Even a junior with a few producing mines isn't a sure bet. The gold it's getting out of the ground has to make up for all the money the company spent bringing the mine online. And if the company has other exploration or development projects on the books, any money it does make will be used to help fund that growth. Also, unlike globe-spanning senior mining companies, juniors can't usually afford to focus on more than a few geographic regions. This lack of diversification makes them particularly vulnerable if something happens in the country they're operating in. If there were, say, a coup or a major natural disaster, senior miners can pack up shop and focus on their other operations, but any juniors working in the country could be wiped out. Given all of these negatives, you might be wondering why anyone bothers with junior mining companies. Well, as with any investment, it's simply a matter of weighing the risks against the potential rewards. And the fact is, in a surging gold market, gains in junior mining stocks could outpace gains in the metal itself. Allow me to explain why. Because junior mining companies are so small and risky, their shares tend to trade at ultra low prices. Many of them trade under $10, and there are plenty that trade for less than $1. That means investors aren't spending much to buy a stake in these companies. So if the company goes bankrupt, it shouldn't set investors back too much, provided they've invested sensibly. Even better, the low price means you can divide your money among several promising junior miners. With the right diversification, you could afford to see some junior miners go bankrupt while hoping the rest of your portfolio will make up for those losses. It can also be a lot quicker to rack up huge percentage gains with juniors. For example, if a $50 stock goes up $1, you'll have a 2% gain. If a $1 stock goes up $1, you've doubled your money. There are more reasons why a junior stock price could soar. Since junior miners have fewer projects on their books than senior miners, any good news related to these projects will have a stronger effect on the company's value. When gold prices are rising, all of these factors are magnified, and that's why, ultimately, junior gold stocks could see gains even greater than gold's rise.